If you follow the VC ecosystem, especially on Twitter, you probably know that there's a lot of discussion around the disruption of VC firms. And behind this disruption, what I think is really happening is the democratization of startup investing. Before, investing in startups was something limited to few people and firms, but now it's changing and more people can invest in early stage companies, which is changing the whole game. Investing in private companies, especially in startups, has always been something more complex than investing in the other major asset classes, such as public stocks, real estate, and to some extent, even bonds. Putting aside the fact whether you have the money for it or not, anyone can invest in Amazon stocks, buy a flat, or invest in government bonds through your banker. But if this same person wants to invest in startups, even if she has the money for it, access to private companies' equity is much harder. And I believe that behind the disruption of VC firms that many speaks about, what is really happening is the democratization of this asset class. It's become easier to invest in startups. I think that there are a couple of forces behind that trend. First, the legal and tech barriers are lowering. The past couple of years, an increasing number of platforms such as AngelList or of investment vehicles innovations such as syndicates make it easier for non-professional investors to invest in startups. It's not only becoming easier to invest directly in a startup, but it's also easier to become an LP, even if you don't have millions to invest or special accreditation. On that note, I think that Europe is really lagging behind the US on that front, which is a pity. Second, more and more people want to invest in startups. The demand for this asset class is growing. On one hand, you have an increasing number of startup founders and employees who understand this model and want to invest themselves. But on the other hand, the market education is also reaching people who are outside the startup ecosystem. Since startup success stories are now well covered in mainstream media, it attracts people beyond our small echo chamber. Third, if the demand for this asset class is growing, I believe that the supply side is also growing. More and more people launch their company and are looking for an initial investment. What's also important to keep in mind is that you have more diversity in terms of startup model. It's not all about VC-compatible startups, as an increasing number of these companies are bootstrapped or solo founder company looking for smaller investment but targeting to be sustainable. My fourth point is linked to the first one about the rise of startup investment platforms such as AngelList and is about better access to information. Whether it's in the stock, real estate or bonds market, investors have access to a certain level of information on which they can base their decision. Since startups are private companies, it's usually much more opaque. But the situation is changing and very often you can access more information about startups looking to raise money. The overall level of transparency is definitely improving. And this democratization is definitely shaking up our industry. These forces are part of the reason why we see a rise in founders investing through rolling funds, like Todd and Raoul's 24 million rolling fund. Also why we see investment vehicles such as Weekends Fund raising money with more than 350 small LPs instead of big traditional LPs. Or finally, why funds focused on profitable startups are also getting more and more popular. So there's definitely more pressure on pre-seed and seed VC firms, especially that many of the new firms that we just spoke about offer support to the entrepreneurs they back. That being said, I don't think it's the end of the traditional VC investing. First, because I think that the market is getting really bigger, so you just have more people going after a bigger cake. And second, because I think that there's real value in being a full-time investor. It's a real job. Many of the founders who set up these funds don't necessarily want to do it full-time. And very often, they partner with real VC firm to do co-investment or follow-up rounds.